Welcome to our revision class today. Today we are going to revise the chapter on the investment decision under uncertainty. And in doing that, we'll be solving a question that was examined in December 2014, question 1. If you are appearing in this class for the first time, I would wish to inform you that you'll be appearing in this class with a hard copy past paper question. We'll be solving mainly past paper examination questions examined by CASNEB. If you don't have a copy, you can get one from our website, download it free of charge. Then you also should remember to appear with a book and a pen together with the discounting tables, and don't forget to carry along a calculator, scientific calculator. Those are important tools which will enable you to revise effectively, so that as you are doing the calculations, you also do your own calculations and confirm the figures. Because remember, at the end of the day, you are the one who is supposed to gain speed, gain skills, and ultimately appear in examinations. So it's important for you to have the relevant materials. So as I said, we are going to look at a past paper question. That is December 2014, question 1, and I read it. The question says, Deepco Limited is a manufacturing company which makes a wide range of products. One of these products requires the use of a special machine. The current policy of Deepco Limited is to replace each machine at the end of its useful life of 4 years. The directors of the company are considering whether to replace the machine more frequently due to the fact that its productivity declines and running costs increase as it gets older. There is insufficient demand for the company's products manufactured using the machine to justify purchase of a second machine. Deepco Limited sells the products made by the machine at 12 shillings each, at which price it is able to sell up to 500,000 units per annum. Variable costs, excluding machine depreciation and running costs, amount to 4 shillings per unit. Details of productive capacities and running costs of the machine are as follows. We have 3 columns. The first column is year of machine life. The second column, productive capacity in units. The third column, running costs in thousands. So the first column we have year 1, year 2, year 3, year 4. And the productive capacity are 500,000, 500,000, 400,000, 400,000 respectively. On the other hand, the running costs amount to 600,000, 500,000, 750,000, 900,000 respectively. The cost of buying the machine is 6 million. The resale values of the machine are 4 million for a 1-year-old machine, 2.5 million for a 2-year-old machine, 1 million for a 3-year-old machine, and 0 million for a 4-year-old machine. The company provides depreciation for its non-current assets using the straight-line method. All costs and revenues are paid or received in cash at the end of the year to which they relate, except the initial cost of the machine, which is paid immediately on purchase. The company has an annual cost of capital of 10% required. Advise the directors of DIBCO Limited on whether to replace the machine every 1, 2, 3, or 4 years. So that is the requirement. You are required to advise the directors of DIBCO Limited on whether to replace the machine every 1, 2, 3, or 4 years. That is our question. Okay? So if you have this question and you are appearing in an examination, I always advise you read it again with the view of understanding and analyzing. You read it again because this paper is examined in English language. English language you read twice, all right, so that you can understand better. So we go through it again. December 2014, question 1. The first sentence, we are told, DIBCO Limited is a manufacturing company which makes a wide range of products, all right? One of these products requires the use of a special machine. That is English. It is a manufacturing company, manufacturing wide range of products. That simply means it manufactures many products. And one of these products that they manufacture uses a special machine. Okay? And we are told, the third sentence, the current policy of DIBCO is to replace each machine at the end of its useful life of 4 years. So it means these machines last for 4 years. At the end of the 4th year, the machines are no longer useful. The machines are no longer useful, right? As we can even see from this particular machine, you can see the second last paragraph. You are told that the machine, the resale value of this machine after 4 years is 0. Scrap value is 0. So these machines are written off completely at the end of the 4th year. So that's what we are told here. We are told the current policy of DIBCO is to replace the machine at the end of its useful life of 4 years. Another sentence we read says that the directors of the company are considering whether to replace the machine more frequently due to the fact that its productivity declines and running costs increase as it gets older. That should also make sense to you. When you buy a machine, as you use a machine, when it is new, maintenance costs are lower. But as it grows older, the cost of running the machine, the maintenance costs, the costs increase as the machines gets older. So the management here, the directors of the company, are considering whether to replace the machine more frequently, say after 1 year or after 2 years. Because if you wait for the machine to run for 4 years, the running cost increases. They increase, as you can see from the table down there. The details of productivity and running costs you can see. Machine 1, the running cost the first year you can see is 600,000. Machine 2, the cost is going up, is 650,000. Machine 3, you can see the costs have gone up, 750,000. Look at machine 4, the cost has gone up to 900,000. That's almost $1 million. 900,000 is not small money, you see? So we are saying as the machine gets older, the running cost increases. So the directors of the company are considering. They need to make a decision. A decision has to be made. Should the company be replacing the machines more frequently due to the fact that productivity declines? The machine's productivity declines as the years progress, right? That is clear. Then we are told there is insufficient demand for the company's products manufactured using the machine due to justify purchase of a second machine. We are also informed DIBCO Limited sells the products made by the machine at 12 shillings each, at which price it is able to sell up to 500 units per annum. Okay, that is a maximum they can sell, and it should make sense. Looking at the table again, you can see the productive capacity of the machine. The highest number of units the machine can produce is 500,000, and we are told that is the capacity of the machine per annum. Okay, so that one, you see, we've been given the selling price of the machine, each machine. Then we are also given other information in relation to the costs. We are told variable costs, excluding depreciation and running costs, amount to 4 shillings per unit. So this 4 units does not include depreciation, neither does it include running costs. The running costs have been given in the table down there independently for the whole year. We are told first year the running cost is 600,000. Second year the running cost is 650,000. Third year the running cost is 750,000. Fourth year the running cost is 900,000. Then we are told depreciation has not been included in the variable costs. Okay, but don't forget, we've been given some information as far as depreciation is concerned. Going down there, down, second last paragraph, you are told the company provides depreciation for non-current assets using straight-line method. Straight-line method. I hope you know what straight-line method is. I'm sure you know it. This was covered. We covered it in section 1. It's a method of depreciating assets, non-current assets, straight-line, whereby the depreciation charged per year for the life of the machine is uniform. It is constant. That's why it is not included here in the variable cost. The reason why depreciation has been excluded is because this depreciation is constant. This is constant. We don't need to factor in our calculations as we are planning to advise this company. It is constant. It is constant. Depreciation straight-line method is a constant charge over the useful life of the machine. So we are told it has not been included in the variable costs. So then we are given the details of productive capacities and running costs of the machine as shown in the table. Below the table, we are told the cost of buying the machine is 6 million. That is the cost of buying the machine. The initial outlay, 6 million. The resale values of the machine are 4 million for a 1-year-old machine, 2.5 million for a 2-year-old machine, 1 million for a 3-year-old machine, and 0 for a 4-year-old machine. These are resale values. These are resale values. Resale values. If the machine is to be sold after the first year, then it will fetch 4 million. If it is to be sold after the second year, then it will fetch 2.5 million. So those are resale values. These are cash inflows at the end of each year. Okay? Then we are also told all costs and revenues are paid or received in cash at the end of the year to which they relate, except the initial cost of the machine, which is paid immediately on purchase. So that simply tells you that all the costs and revenues, we are told, are paid in cash at the end of the year. Those are future values. Those are future values. At the end of the year, those are future values. But the 6 million, we are told the initial cost of the machine is paid immediately on purchase. That is present value. Okay? The initial cost is present value. You pay today. You don't pay later. You pay now. So that is present value. But the revenues or the costs are deemed to be paid or received at the end. So when we are making our calculations, we need to discount these figures. Okay? Then the company has an annual cost of capital of 10%. So that is the question. Then you are told, advise the directors of DIBCO Limited. Advise. Don't forget, these directors cannot make this decision because they are not trained to make such decisions. That's why they rely on you, the expert, okay? Because you have studied advanced financial management. These are decisions that are supposed to be made. You don't make such decisions on gut feeling. You need to do calculations. You need to base your decision on facts, all right? You don't make such decisions based on any other way other than calculations. So the directors, we are saying, we have been told in the questions, the directors of the company are considering whether to replace the machine more frequently due to the fact that its productivity declines and running costs increase as it gets older. They are considering. They've not made a decision. You are the one to advise, all right? That's why in this question you are told, advise the directors on whether to replace the machine every 1 year, every 1, 2, 3, or 4 years. So we need to understand the question. Advise the directors of DIBCO on whether to replace the machine after every 1 year, or after every 2 years, or after every 3 years, or after every 4 years. So we'll do the calculations because we've been given the information for the 4 years. Year 1, we have been given the productive capacity. We've been given from year 1 to year 4. We've been given the running costs from year 1 to year 4. We've been given variable costs, all right? So with this data, we should be able to advise the directors of this company, okay? And how do you advise? How do you advise? That's very important. How do you advise? Before you advise, remember, advanced financial management, we use very many techniques in capital budgeting. So on the outset, you need to determine in advance this kind of a scenario, this kind of a problem, which technique are you going to use in order to advise? You need to, it should be clear before you start. Are you going to use sensitivity analysis? Are you going to use scenario analysis? Are you going to use simulation analysis? Are you going to use NPV? Are you going to use profitability index? Are you going to use IRR? Are you going to use internal rate of return? Are you going to use, which technique are you going to use? Are you going to use the payback method? Those are some of the techniques we use in investment decision. Are you going to use certainty equivalent? Are you going to use risk-adjusted discount rates? Which method are you going to use? The method you are going to use will determine whether you'll advise these directors effectively or not. It will also determine whether you'll get the marks for these questions or not. Okay? So, that is a question we need to answer. And I know this you covered in your class, our normal class. This one we looked at in detail. So for this question, we'll be solving this question using the annual equivalent. We'll use the annual equivalent method. And annual equivalent method, we are saying, is a method that is relevant for this question because it is often used as a decision-making tool in budgeting, capital budgeting. when comparing investment projects of unequal lives. We use the annual equivalent. Okay, this one we have different the different lives. You have 1 year, we have 2 years, you have 3 years, you have 4 years. The periods, the lifespans are unequal. So when you have that such data, you use that technique. Okay, but you need to remember also that you can only use this technique if the projects that you are analyzing are exposed to similar risks. If they are not exposed to similar risk or equal risk, then you should not use annual equivalent. Okay, so we need to calculate the annual equivalent for year 1, annual equivalent for year 2, annual equivalent for year 3, annual equivalent for year 4. Then based on the annual equivalents for the 4 years, then we will be able to advise, because the year that will have the highest annual equivalent will be the optimal policy to replace the machine. Optimal policy to replace the machine will be that year that has the highest annual equivalent. So how do you determine annual equivalent? That's another question. How do you calculate the annual equivalent? There is a process. First of all, we need to determine the net present values for each year. Net present value for each year. You need to determine the net present value for each year, and in the question we have all the details to help us calculate the net present value. Net present value. Okay, and you all know net present value is equal to the difference between the present value of the cash inflows and cash outflows. So we have cash inflows in this question, and we have cash outflows. The difference will give us the net present value. Okay, we get the present value of the cash inflows, because remember we said inflows are in future terms. Remember, we talked of future terms. The money that is we are told in note number, we are informed here that let me read it. You are told that where is it? The cost of buying the machine is 6 million. The resale values for the machine you are given. We are told here in last paragraph that all costs and revenues are paid or received in cash at the end of the year, to which they relate at the end of the year. So we will discount these revenues. We will discount these revenues to get the present value. That's what we are going to do. But first of all, we need to analyze the question. You now take your pen. Help me analyze this question on the board. As you analyze on your paper, okay? I have a whiteboard. You'll have a white paper, right? So we analyze, and our objective, don't forget, is to advise